I'm Ian Castle, founder of Microcap Club, home to the best microcap stock pickers on the planet. Since 2011, our members have profiled over 1,300 microcap companies, with over 290 turning into multi-baggers. That's more than one big winner every single month for 14 years. If you share the passion for finding great companies early, before Wall Street and the institutions, Microcap Club is where you belong. Join us.
We have Russell Stanley, who's Managing Director of Research. Russell, take it away.
Thank you. My name is Russell Stanley, MD of Equity Research at Beacon Securities. Thanks, Robert. Thank you, Planet Microcap, for having me here to give me the opportunity to tell you about one of my top picks, Firan Technology Group, FTG, on the TSX. Market cap's just over $250 million. We have a buy rating, $17 target. Stock closed yesterday at about 10.32. I think it's down a little today, but that implies roughly 65% potential return to target. I don't own the stock, and we've done no banking for the company. By way of background here, the company manufactures electronic products and subsystems for the aerospace and defense markets, operating out of facilities in Canada, the United States, and China, also standing up a facility in India. There's really two business lines here. The first is the circuits division, which manufactures printed circuit boards. So what is a printed circuit board? Well, I look at it as the physical foundation or platform upon which other components sit in an electronic device, which you find plenty of in fighter planes or commercial jets. And part of FTG's work is etching the pathways for these components to talk to each other. So for Star Wars fans out there, I see circuit boards as the Force. It is a circuit board that connects those electronic components and binds that galaxy together. So obviously mission critical. FTG's Circuits division focuses exclusively on aerospace and defense, where, as cliched as it sounds, failure is not an option. Customer specifications are naturally extremely demanding. And this business contributed roughly 2/3 of revenue last quarter. The second business line is the aerospace division, manufactures cockpit panels, keyboards, and increasingly sub-assemblies, higher level assemblies for use in aircraft. Late last year, FTG acquired Flight Aerospace, a name many of you may remember. This significantly boosts the growth potential, I think, for the aerospace division by adding a number of products and expanding FTG's presence in the aftermarket. And that's the other 1/3 of the company's current revenue base. What unites these divisions is some commonality in the customer base, most notably RTX, the world's largest aerospace and defense company, GE Aerospace, Honeywell, and Bombardier. But the ultimate end users include, of course, the major commercial jet manufacturers, Boeing and Airbus, as well as major militaries. And so we see the company-wide revenue mix is roughly 60% commercial and 40% defense. So FTG, by way of background, had been on our radar screen for a number of years, but I was reintroduced to the company a little more than a year ago. The market cap had surged past 100 million, and that's an important level for a lot of institutional investors to begin looking at a name. So we initiated formal coverage in January of this year, originally with a $12 price target. We've since increased it twice to the current $17 share level. Quarterly results have been very strong relative to our expectations, and with the most recent results, Q3 numbers, I'd highlight new orders were particularly strong, up 12% year over year and quarter over quarter. Book-to-bill improved sequentially to almost 1.1 times, which is great to see. And the cash flow and cash flow conversion numbers were also very impressive. But I think it's important to understand that over the last 12 to 24 months, the company has seen consistently strong, robust demand from across its end markets, and that's relatively unique. Traditionally, I think Firan has seen demand strength in some programs, some end markets, and softness in others, and the hope is that the net offset still improves growth. But right now, the company has, and for some time now, has continued to see strong growth across its end markets. That's all cylinders firing at the same time, which is particularly interesting. Our thesis in a nutshell, strong commercial demand evidenced by the production and delivery expectations for Boeing and Airbus, which we highlight here on the slide. Strong defense demand. You've got spending growth there poised to accelerate for a number of unfortunate geopolitical reasons. And thirdly, FTG is particularly well positioned here between high entry barriers to the space and its own unused plant capacity. So taking a closer look at the commercial demand here, diving into this aspect of our thesis, Boeing and Airbus expected to take their production up by an aggregate of 13% next year, following a fairly sizable lift of 26 to 27% this year. As many of you know, Friday, Boeing received FAA approval to increase production of its 737 model. That's a big step forward for that company. And last week, just before that announcement, Boeing announced that its Q3 deliveries actually beat street high forecasts for the quarter, which demonstrates the company's ability to ramp up, which is meaningful given its production travels of the past several years. The Airbus outlook looks similarly strong, with production growth expected to grow 7% this year and accelerate to 11% next year. FTG is content with both companies, and it's also a supplier to China's C919 program, which is envisioned as a competing model to the Boeing 737, the Airbus 320, the workhorses of those manufacturers. That C919 program is now in commercial production and should see strong growth over the next several years. Thinking about it this way, based on consensus expectations for deliveries next year, Boeing's current backlog represents almost 9 years of production, and Airbus's backlog represents almost 10 years of production. So there's an awful lot of work to be done. Much of that demand growth comes from Asia, although it's worth noting that we see two additional tailwinds to talk to. The first is the One Big Beautiful Bill Act, which contains provisions that restored rapid depreciation on purchases like this. So the after-tax cost of buying an airplane is now more attractive thanks to that legislation. And the second is trade, as Boeing observed during its late July earnings call. Buying an airplane is a really quick way to address a trade surplus with the United States. So those are two interesting tailwinds I think are worth talking to. So demand on the commercial front looks very strong. Let's talk about defense here. It's the next pillar of our thesis. And unfortunately, geopolitical tensions are driving defense spending higher. Seems almost everyone's ramping up spending at this point, and FTG plays here as well. Let's take Europe, for example. As you know, NATO members pledged to increase their spending on defense from the prior 2% target to 5% of GDP by 2035. 1.5% of that is defense-related infrastructure. So for our purposes, we'll ignore that. Let's look at the 3.5 number. Going from 2% to 3.5% doesn't sound like an awful lot, but really that's a 75% increase. So very meaningful. And you want to put that into dollar terms here. The 5 largest NATO members in Europe would have to increase their aggregate spending by over $230 billion US annually in order to reach that target. So translates into major dollars here. And moreover, there's a lot of pressure to buy locally in Europe. The European Commission issued a document last week encouraging its members to do just that, particularly given up and down relations with the United States. At the company-specific level, this morning's earnings reports also bode well for FTG. RTX, company's largest direct customer, world's largest aerospace and defense company, reported Q3 revenue and EPS that beat street high expectations. They raised their 25 guidance, talked to strong demand, and that stock is up, I believe, almost 9% on above average volume as of when I left my desk. They reported $37 billion in new orders during the quarter. That's a book-to-bill of over 1.6 times, which is very strong. And that, of course, bodes well given their prominence in FTG's picture. Also, Lockheed Martin, bellwether in the defense space, also called out strong results, lifted its guidance a little more modestly than RTX did, but they saw as well unprecedented demand, as they called it, and pointed out record deliveries of F-35s in the quarter. That is, I believe, a program that FTG supports. Other major customers, including Honeywell, GE Aerospace, and the big commercial jet manufacturers all report over the next couple of weeks. So we'll get updated demand outlooks from core players, but the early indications are very positive. So demand looks strong across commercial and defense. Let's walk through why FTG is positioned to continue winning here. They're sole source on 80% of the work that they do for their customers. And I think that reflects or is a strong endorsement of product quality and reliability. This is a high entry barrier business. Customers often require that your facilities be qualified, meaning extensive inspections and documentations. That's a process that can easily take 6 to 24 months. And it's facility specific. So just because FTG's facility in Toronto is qualified with a customer, that doesn't necessarily mean that their facility in Minnesota is qualified yet with a customer. And you have to walk through that as well. And that is an effort that the company stays on top of. Moreover, regulators and militaries may also require certifications from your facilities and even from specific products. So all of this means that once you win business in this space, it's very, very sticky as long as you execute well. And FTG has done an excellent job in doing just that. All of this gives FTG high revenue visibility, which we obviously view favorably. And as an add, the company has strong physical plant capacity that could support $250 million in annualized revenue. That gives them a lot of runway on organic growth. We have them doing a little bit better than $190 million this year and $210 next year. So there's runway beyond our formal forecasts based on their physical plant capacity. We also believe FTG stacks up well against the company we see as its closest peer. That's TTM Technologies, TTMI on NASDAQ. I don't cover that name. I don't own it. We haven't done any banking for them either. TTMI, is larger by market cap, more liquid stock. And even though aerospace and defense is its largest end market, 55% of its revenue comes from outside of aerospace and demand. And for all the reasons we've noted, we really like FTG's focus on aerospace and demand, so I call that out. FTG also has a stronger top-line growth profile, stronger current and expected margins. What does all of this mean? It means that our forecast for FTG calls for triple the EBITDA growth and 4 times the earnings per share growth over the next couple of years. Nonetheless, FTG trades at about 7 times next year's EBITDA. That's a 46% discount to where TTMI trades. If you want to use another comp, look at Astronics. Ticker is ATRO. Don't cover that. We haven't done banking there. But that is also trades at over 12 times. FTG gets a 42% discount to that name as well. So steep discount to the closest peer despite offering significantly stronger growth. Potential catalysts for FTG include product certifications. Those are a strong precursor to sales, of course. Contract wins. M&A activity. We think Europe should and will be a strong priority here. And the Q4 results, which we'd expect in February. From a technical perspective, I don't have a chart in the deck, but the stock bounced off its 200-day moving average late last week and looks like it's holding around the 10-20 level. So for chartists out there, that represents a 38% Fibonacci retracement. So if you're a believer on that front, good time to re-enter. So still very much one of our top picks. It was great to see CEO Brad Bourne pick up a little additional stock last week. He owns 11% of the basic outstanding, so he is aligned. We obviously love to see that. That concludes my remarks, and I think we've got just over a minute for Q&A if we can squeeze one in.
Yeah, just a quick question. What does flight add to the capabilities of Firan? The flight acquisition,
Yep.
What does that add to their capabilities?
Three major benefits. One, it got FTG deeper penetration with Airbus. Airbus has been outperforming Boeing now for several years. I think if you look at backlogs and production expectations, Airbus has a roughly almost 60% share. So it gets them deeper with Airbus. It also gets FTG more revenue in the aftermarket space, which typically is much higher margin than OEM, which is good to see. And it also adds some additional products that Flight had done an excellent job developing, but hadn't monetized yet. And now, the mandate is to go out and sell. So far, the company has achieved certifications for one product in particular, both in Europe and in Canada, and expect more to follow. But those are the three main benefits of that transaction.
Any more questions? Oh, yeah. Here you go.
And you got cash flow from operations growing by 46% year over year from 24 to 35 million bucks. Can you talk about the tax loss carry forwards that came with the Flight Aerospace acquisition to keep the tax man at bay, and how much that might contribute to your margin expansion?
Yeah, we don't really bake that in. Bob, thanks for the question. We don't formally bake in anything. We just use an effective tax rate, I think, of 26%. I can double check that and circle back. I would view anything on the tax loss forward side as upside at this point, where priority for Flight is really seeing them actually monetize those products. But there is upside from the tax loss forwards. I haven't baked them in or given them credit in our valuation.
Did somebody else over here?
Hi. What are the historical maintenance CapEx, and what should we look for? How should we think of it going forward?
I think the CapEx for this business is relatively modest. I think you should probably think about it as being kind of 3 to 4% of sales, maybe a little bit higher than that. Most of, as we noted, they've got capacity that could support $250 million in annual revenue. But there are multiple facilities at work, and the Toronto facility, for example, is running 24/7, which reflects demand. So there isn't a lot more you can eke out of that facility. I think the company is looking at a CapEx program there where for maybe several million in CapEx, they think they could add 20 million in revenue capacity, so there's an opportunity there. But otherwise, as far as organic CapEx is concerned, near-term needs, I think, are fairly modest. From a quarter-to-quarter basis, as far as cash flow goes, there's more volatility or more of an impact from working capital depending on what receivables and inventories do. But otherwise, you're looking at what I think is a fairly modest CapEx profile.
One more question? We have time for one more. Anybody else? Okay. Thank you very much.
Thank you.